selling your investment property and considering a 1031 exchange? Is Hawaii a good place for my investment? Today, I'm going to be talking about the 1031 tax-deferred exchange process, and yes, Kona, Hawaii is a great place to park your 1031 property. Let me introduce myself. My name is Stephen Proski, and I am a real estate broker with Corcoran Pacific Properties here on the Big Island of Hawaii. And I've been assisting people like yourself successfully buy and sell real estate for more than 20 years. If this is why you are here, thank you. And could you please hit the subscribe button below so you can be a part of my ohana. Hawaii is a great location for rental properties, as you can imagine, from small condos up to multi-million-dollar beachfront properties. There is a very high demand for not just short-term rental properties here, but long-term rental properties as well, in and around the Kona area. And this, my friends, can be an ideal 1031 property candidate for you. So let's jump into this topic today. If you are not familiar or heard about the 1031 exchange, it is a swap or an exchange of one real estate investment property for another that allows capital gain taxes to be deferred. The term 1031 gets its name from the IRS tax code section 1031. The 1031 tax deferred exchange process was initially established in the 1921 Revenue Act, and there have been only a few minor changes since its onset. If you own any real estate investment property, then there are several benefits of taking advantage of this option. Capital gains taxes can be a sizable amount of money. Using those funds that would have otherwise gone to taxes, you could put towards another investment property, which allows you to have more money available for that purchase of your replacement property. If your investment property is not profitable, you can exchange it for a different property that will make you money. This is an effective way to diversify or leverage your investment portfolio with minimal risk. So, who should be involved with your 1031 exchange process? Well, the first person is your tax advisor. Yes, your CPA. They will establish the value or values of the property or properties in question and advise you on the proper structure for your transactions. Next on your list is a qualified intermediary. If you don't know who this is, they are the person who prepares all documentation needed for the exchange, consults with your tax advisor, executes all closing documents, holds the exchange proceeds, and coordinates between the various professionals involved in your transaction. They are required by the IRS Treasury regulations, and your intermediary does not need to be in the state where your 1031 exchange is done. And the last person on the list is a real estate professional.
Hello there.
Like myself, with very specific timelines to maintain and specific requirements that must be met. A realtor proves to be a great resource in this process. So, does my property qualify for a 1031 exchange? That is a great question. There are 4 types of potential tax-deferred exchanges: the delayed exchange, the reverse exchange, the simultaneous exchange, and the improvement exchange. To learn more about these 4 different types, I would highly recommend you discuss these with your tax professional, who will be in a better position to explain them in greater detail. Okay, we've learned that doing a 1031 deferred exchange can be a benefit for delaying paying capital gains, but are there any reasons why not to use a 1031 tax deferred exchange if I am selling a real estate investment property? Well, if your replacement property is purchased for less than the relinquished property that was sold, then gains are not realized and taxes are paid. However, if the replacement property is at least $1 more than the relinquished property gains can be deferred. The disadvantages of a tax-deferred exchange include a reduced basis for depreciation in your new property. The tax basis of the replacement property will be the purchase price of the replacement property minus the deferred gain on the relinquished property. The replacement property includes a deferred gain that will be taxed in the future when the property is sold without an exchange. A 1031 is not the right investment for everyone and is highly recommended and encouraged that you discuss this process in detail with your tax professional. In order to qualify for a 1031 exchange of real estate, 3 specific qualifications must be met. First, the property that you are selling and the property that you are purchasing must be held for the productive use in a trade or a business or for an investment. Second, the real property must be exchanged for real property, not personal property. Third, in order to have 100% deferred of your tax liability, your replacement property or properties need to be equal to or greater value than what you sell your relinquished property minus customary closing cost. Anything below that number will be exposed to taxes up to the extent of your gain. You need to reinvest both your basis and your gain. That is why we are looking at the sales price and not just the net proceeds. Okay, you decided you want to move forward with selling your investment property and buying another investment property utilizing the 1031 exchange process. Are there any timelines I need to follow?
Yes.
Before you can begin, you must notify a qualified intermediary your intentions to sell your investment property as a 1031 exchange. Within 45 days of closing on your relinquished or sold property, a replacement property must be identified and conveyed to your intermediary in writing. Yes, you can identify up to 3 properties during that 45-day time period, but once that time period has exhausted, you can no longer identify another property. Within 180 days of closing on your relinquished property, you must close and record your replacement property utilizing the 1031 exchange process because timing is everything. Failure to meet the 45-day or 180-day deadlines negates the entire 1031 deferred exchange. Are there loads of extra fees associated with the 1031 exchange? Great question. Some of those fees associated with the 1031 are setup and or administration fees from the intermediary, and that is per property that they're charged. Transaction and or service fees such as wire transfers or check reimbursement fees are also associated with the cost. You may also be charged for normal title company fees as well. Your qualified intermediary gains about 2/3 of their fees from the interest earned on the funds that are deposited from your 1031 exchange. Again, you should discuss this matter in greater detail with a qualified intermediary.
You hear me, Slick?
If you need a recommendation to a qualified intermediary, please feel free to reach out to me. I work with several good 1031 intermediary companies over the last several years. This is a good amount of information to take in, but if you are considering that a 1031 tax-deferred exchange is good for you, start your discussion with your tax professional, then onto a qualified intermediary, and finally a realtor or real estate professional. Hope this was an interesting topic for you, and if you wanted further information about the 1031 exchange process or any other real estate related matter, feel free to reach out to me here and I'd be glad to help. Thanks for watching. Hope you have a great day. Aloha.